When President Trump says, and this is quoting him directly from True Social last night, that these are short-term higher oil prices, that they will drop rapidly when the destruction of Iran's nuclear threat is over, to what extent is it true? How quick could that actually happen?
So this is a great point, and I think we should distinguish between the type of disruptions that we're talking about. If we are talking about logistical disruptions, meaning the ships are loaded, they're sitting outside the Strait of Hormuz, and we're just waiting for it to open up for those ships to kind of get where they need to go, we're talking about something that can kind of heal the market rather quickly. 10, 12 days to get to where they need to be to export the crude, right? But once we start talking about supply shut-ins in the Middle East, and we're starting to see that happen in Iraq, 2.5 million barrels and 500,000 barrels in Kuwait, then you're talking about a much longer process to get those barrels back online. It's not just they're sitting there waiting to move. You need to restart the system, which then takes a couple of weeks, and then you need the shipping through. So you kind of have to amplify that timeline when you talk about production that's lost, as opposed to just logistical constraints.
And so here we have the largest oil disruption in market history. If that 20% remains locked up, did we get a sense this morning, Rebecca, of what prices could look like? That jump to almost $120 a barrel really spooked a lot of investors this morning. When could we see that number again?
So I think you see that number when we have lack of confidence on a timeline and a plan. So when there's this open-ended timeline, the market knows we have SPR. We have a tremendous amount of SPR in the global market. We have inventories. We have floating storage. We have China that's built up their inventories. The market knows that, but it can't wrap its head around how meaningful that will be if we can't put a timeline on this. So that panic will resume as this timeline becomes more opaque. So I think that's the key thing the market is trying to evaluate, is how long does this last? I know I have some buffers built in. I know there's some levers we can pull, but these are not indefinite. And when I shut in production in the Middle East, those levers effectively run out a runway to help us, and we get those spikes again. So I think that's where you start to see these things come back into play. And it was a really good example overnight. Your previous guest did highlight that there were some technical factors at play, certainly on the open and the overnight session. There's been a tremendous amount of call options trading in Brent crude. Dealers came in short and needed to cover, but that's going to reaccelerate. That trade isn't over, and could certainly see those types of panicked moves again.
Well, so if we continue to see the panic moves and the pressure to the upside, Rebecca, off of concern over a supply shock, at what level does this become not about supply, but actually turn into a demand destruction conversation?
That's a critical question. There's a lot of analysis being done on that, I think, across the street. When I look at, on an inflation-adjusted basis, if we look at the spike that happened in 2008, we're looking at much higher crude prices, kind of over 200 if we inflation adjust where we would need to be to see that type of impact. I think the key metric that you've talked about is $4 gasoline prices in the United States. That's where you start to see an impact in the U.S. For emerging markets, it's different, right? I think when we start to see $150 crude for EM countries, that's where you start to look at seeing some real demand destruction start, and it will accelerate from there. Those are the benchmarks that are being thrown around. Again, we have to see how this evolves, and the time at which it spends at those prices is critical. If it's short term, we can absorb it and move on. But if this has that open-ended timeline, you will see the demand destruction start to be much more extreme.
As they say, the best cure for high prices is high prices. Rebecca, I want to ask you about Karg Island, because there are reports out there today that the United States may consider seizing Karg Island, which is about 15 miles off the coast of Iran. And it's kind of the transfer station, if you will, where tankers are loaded up before they pass through the Strait of Hormuz. The conventional wisdom here in Washington is you would need boots on the ground to do that. And I wonder if the United States chose to make that move and seize the centerpiece of Iran's oil industry here, is that an all bets are off moment, or would that reassure the market knowing that that site was secured by Americans?
Great question. I tend to think that's an all bets are off moment. That to me is Karg Island has been maintained throughout the course of this conflict. It wasn't touched during the June 12-day war. It's how we think about the long-term preservation of, crude output and supplies. And if you go after that, you've got to be able to move that crude through the strait. That means you are 100% invested and in the strait, having to protect every single ship that goes through. I don't think that will provide the market confidence unless the strait is also open. So it has to come hand in glove with a logistical output for that crude that can be safely transferred. Just going after it without that, I think actually does the opposite for the crude market and may create a more panicked environment.
Well, and when we consider the wider environment, Rebecca, it's one thing for crude and product prices to go up in and of themselves, but that, of course, can feed through into other prices, too. When we think about the idea that you need fuel to get the things that ship goods to consumers and customers all over the world, how quickly could we be talking about this being a reinflationary kind of thing? I know you said a lot depends on time and duration, but what is the lag on that feed through to costs elsewhere?
Well, if we look at just the move in gasoline prices last week, you can see that there's been a pretty quick transition mechanism into at least gasoline prices. How it filters through into the rest of the products that crude is an input for varies dramatically by industry, right? So we're going to see some things that have a much quicker uptake of it and some lagged. And there's very smart economists out there, I think, who are trying to figure out this exact question. But I think it's months. I don't think it's a week scenario. Is it 3 months? Is it 6 months? It's likely in that window of the timeline that I hear from economists on terms of how much impact it takes or how long it takes to flow through into prices. But again, it will vary by industry, and that'll be something I think the equity market will be watching exceptionally closely as this extends out longer.
How do you read the lack of movement in oil stocks, Rebecca? We're talking so much about the commodity. I'm looking at Exxon and Chevron here. They're up modestly. The XLE is down 7 cents, and they've been kind of just floating around for the last week plus while this has all happened. Does that imply to you that stock traders see this as a short-term blip?
I think it implies two things. First, there was a tremendous buildup in energy equities leading up to this event. So they priced in a lot of this kind of heading into the event. In the last week or so, when we've seen this kind of volatility-driven increase, it's primarily in the front of the curve, right? The back of the curve is still relatively anchored. And that does speak to the timeline that I think the market is using, which is, weeks, a month, but not extended. And unless we see the back of the curve start to really adjust higher, then we could see the next leg higher in energy equities. But I just don't think with the back end at 65, we're looking at, a windfall for equities. It will take a more dramatic move, and knowing that this is going to be a long-term, not transitory event for that reacceleration, I think, in the equities.